Welcome back. You're watching Big Deal, and we are focusing on the ways to broaden the secondary debt market in the country. Let's take it to Ashish. Ashish, of course, there are two ways and two types or buckets that we can divide this particular market in. First of all, the kind of opportunity that the foreign funds can see when it comes to the good loan situation in the country. And while the government has been looking at the opportunity of probably forming a bad bank for taking over the bad assets, for that also there are investors overseas who are available. But of course, the good loan situation also emanates out of some solution of some distress situation. Now, how do you see the two markets developing at this point? And are there enough takers sitting on the fences for these regulations to be relaxed for them to come into the country?
Yeah, absolutely, Nisha. I think it is today, given that we have not only an asset side crisis, but we also have a liability side crisis, which is really creating a huge amount of liquidity problems. So to that extent, I think really solving for right structures and right routes to allow trading of good assets is also very important, because what it really does is that a lot of foreign capital and some of the while equity funds have been now around for a while, but the distressed credit funds and credit opportunities funds, etc., has been relatively new entrants into the system. So some of these good assets actually attract them to make bets on India, and as they start entering into India, then they are more probable of opening themselves up to more difficult assets. I think people are already looking at both of these things, but the attraction and the pace at which we can attract this capital by offering some of the good loans, which any which ways needs to be traded because local NBFCs and sometimes banks needs to solve for liquidity issues. We have seen some of those transactions happening. We're actually looking at and scouting the market, and we can see some of those more transactions in the offing. So I think it will be a good balance. I mean, today, for example, a couple of these things, like you still need a securitization trust to trade a good loan. I think that's a dampener. Our securitization regs are designed to really deal with large pools of money, mostly retail money, and they're not designed to really deal with corporate loans. So that's a bit of a dampener, and we need to solve for that. I think maybe the other experts can touch upon that, but this 50-50 issue is a bit of a dampener. You need to get two financial institutions of sophistication to agree to exact same terms on a transaction, which generally doesn't happen. So, so that sometimes creates a bit of a problem. So these are some of the things that these are some of the low-hanging fruits that we can deal with when it comes to good loans. And as we solve that, as we create some bit of a market around that, I think the attraction, or basically the appetite to deal with more difficult loans, keep increasing. Once you allow an organization to set up base and take some bets in India, I think they are generally more interested in continuing to grow and go beyond, what they may have contracted initially.
But Bhavin, Ashish was mentioning about the FPI restriction of 50-50. How big a restriction is that?
It's a huge restriction. So FPI is the most efficient way to really pick up loans in India through either asset reconstruction company trust or the securitization trust. For ARC trust, which is bad loan trust,
yes,
RBI has clarified that one single FPI can pick up 100% of the stake.
Right.
That clarification is not applicable for good loan trust or even investment into non-convertible debentures directly by FPI into a company which is in stress.
Right.
That requires, as Ashish said, two institutions to agree to exactly the same terms and underwrite the same cash flows at the same risk, etc., which is very tough.
Right.
And that's really causing a lot of trouble.
Is that addressed in the recommendations? Is there any point of view by the Reserve Bank on this?
There has been several conversations to take that away, and those conversations resulted in resolving it for bad loans, but good loans, there has not been many conversations. RBI needs to look at it.
All right. And Nishchal, what is the role of AIFs in this entire process?
So I think currently, as far as bad loans are concerned, ARC is the only solution. But as we discussed, the problem is ARC in a way is a forced solution on the foreign investor. Right. A foreign investor, even if he wants to do a direct deal in India, the government is telling them that you have to come through an ARC. In which case 15% has to be put in by ARC, 85% by the foreign investor.
And then ARC also charges the fees.
And then ARC charges the fees. So I think the problem is that you are dependent on an external third party for the entire structure, even though 85% of money is yours. Right? AIF solves that problem because as a foreign investor, the foreign investor through its manager can own an AIF in India. 100% of money which is put in by the foreign investor can be used for the purpose of acquiring loans, which again today AIFs are allowed to invest only in securities, which means they can invest in debentures. But buying of loans is something that has been recommended in the report, but is not happening today. And in fact, we are facing a live situation where AIF wants to buy loans from the NBFC or the HFC. But the problem is that first the loan has to be converted into debentures and then only AIF can buy. Now the moment it has to be converted into debentures, you need support of the borrower. Then the borrower comes to renegotiate the terms. That you reduce my interest. Anyways, you're going through the restructuring. And then there is stamp duty, which is applicable when the debentures are issued. So a lot of issues just because AIFs are not allowed to acquire loans, which the report is trying to solve. So AIF actually solves a lot of problems for foreign investors versus an ARC structure for bad loans.
Those are very real life practical problems that you just highlighted. But then, Bhavin, to the larger question, and before I wrap, there is a good side and a bad side to everything. And at this point, I don't know whether the government as well as the regulators will be willing to take too many risks by providing too much flexibility for any financial instrument in the country, especially after the way the mutual funds have suffered because of loans against pledged shares by the promoters. So the recommendations also include the mutual fund industry as one of the investors to broaden the debt market, the secondary debt market. What are the risks that we may deal with? And all this can come from the experience that you have seen in other developed countries where this market is deep enough and mature.
Sure. So I think the prudent way to go about this would be to take baby steps. The stress assets are highly risky assets. When you talk about mutual funds would have public investors. They have limited information. They rely heavily on the asset manager's abilities to, find and pick right opportunities. So I would say that initially, if this particular opportunity to invest is opened up to all other industry players like FPIs and say AIFs as well, because again they're sophisticated investors. But mutual funds is taken as phase 2. That would be more appropriate.
All right. So gentlemen,
in fact, I think the reason why this recommendation should go through is because most of the investors which they've mentioned are sophisticated investors, and corporate loans are very complex loans, right? Because you need to understand and most of the loans by NBFCs and HFCs have been to the developers, right? Real estate itself is a complex sector, right? For retail investor to understand, which is wherever retail money is involved, I think there should be caution which should be exercised. But as far as sophisticated investors are concerned, I think this recommendation should be implemented fast, because otherwise we'll miss out on time and the opportunity will be lost.
All right. So the need of the hour, and that's what is a clarion call for at least all our panelists, that we need to deepen the secondary debt market in the country, of course, with caution and from the learnings of the past from other developed countries. Whether or not the RBI's recommendations at this point cover all the aspects, and especially the tax aspects, is something also that the investors will be watching out very closely. But we saw an influx of the private equity players in the country in the last 2 decades, and there could be more influx of these investors coming in to broaden our debt market as well in the coming years if there is some relaxation on some of these rules, which is going to be very important to take care of the distress situation in the country. Thanks so much, Nishchal, Bhavin, as well as Ashish for joining us, and this will be an ongoing discussion as and when things improve on this situation. With that, it's a wrap on Big Deal. Thanks so much for tuning in.